Okay, so up till now, this has been like really, I would say, background information, just kind of laying the scene of, what is a corporation, what is accounting, what is GAAP. This is the first like true accounting thing that we're going to introduce. It's the basis of everything. Okay, this accounting equation: assets equals liabilities plus equity. Okay, this one framework, you can build all of accounting and business is kind of summarized in this one thing. Okay, it's a quite powerful framework to think about uh, business, even your personal finances. Okay, so maybe we can just define some of these terms, and then I can show you how this equation like kind of translates into like you could summarize an entire business with just this one equation. Okay, so the claim that I'm going to make is that this equation is at every moment in the life of a business, it's always going to balance. The assets will always equal the liabilities plus equity. Okay, it's after every transaction, after every event that this business like incurs or whatever happens to it. This balance, this symmetry will always hold true. Okay. Now, of course, now the question is, what are these things, right? What do they mean? An asset is something that the business owns or has rights to, which give it a present or future benefit. So we've already named a lot of these things. A delivery van, right? If your company owns that delivery van, you can use it now if you're UPS to make deliveries. It's going to last 3-5 years. You're going to be able to use it in the future and continue to get some benefit from it. Okay. Um, the other big ones, okay, the king asset, okay, is this first one right here. Does anyone know that Wu-Tang song? Cream, cash rules everything around me. No, it's like cash is the ultimate asset. Why do you think that is? Does anyone have uh, any insight or any intuition about why cash is king? Yeah, it's what? I mean, for certain activities that could be useful, but for a business, why is it useful? Okay, it's totally it's already in a spendable form. Yes. Okay. Any other intuitions? What can you do with cash? Cash is universal. Okay, you can buy other assets with cash. You can pay your expenses with cash. It is it is kind of like the blood that's flowing through your business to make everything else happen. Okay, so it's universal. It's already in a spendable form. Okay, so it is like the lifeblood of a business is its cash flow. Okay, so the balance of cash that your business has, that's going to be it's like one of the primary assets that it's gonna that it's always listed first. Okay, it's like most always listed as the first asset on the balance sheet. This is the financial statement we're going to learn about because it's so important. There's even one of the financial statements is just for cash. Cash flow statement is just a statement about the flow of cash within a business. So it's like that important. Okay, investments. What are these? What are some examples of investments that a business can own? So a loan to someone else. Okay, we call this a note receivable. Note receivable is a type of investment. Okay, what about we talked about Silicon Valley Bank. What was uh, the thing that they owned that kind of caused them to go bad? It was a loan, but who are they lending to? Does anyone know the details of this? How do you lend to the government, the U.S. government? Bond. Okay, that's a type of investment that can be owned by a business because you own the bond. If it's a 30-year bond, you're going to receive interest payments for 30 years. And at the end of 30 years, the government gives you your original money back. So that fits this definition of an asset, right? You're going to receive future benefit and present benefit because you'll get paid interest now too. Inventory. So we had this example of the store that bought inventory, held it, and then sold it the next month, right? So that is an asset. That inventory, when you first purchase it and you're storing it in your warehouse or in your store, it's going to give you some future benefit when you sell it, right? But until then, you're going to hold it as an asset. Property, plant, equipment, uh, also known as PP&E. If you're Tesla, you got a lot of this, right? You got factories, you got all the machines, manufacturing equipment, um, all the, all the whatever, all the stuff that they use to build cars. Okay, uh, Google used to be a software business. What do they have a lot of now? What's their PP&E that they have spent billions and billions of dollars on? Yeah, but what is running the AI? Where does that all happen? Data centers. Okay. Google is no longer a software business. If you look at their balance sheet, which I think we'll do at some point, they own a ton of data centers. It's like essentially like they're like a car factory now. They have this huge overhead of capital. Okay. They needed to spend money to set up these data centers. Okay. It's essentially like a car maker having to set up a factory. It's like it's no longer that same software company that had just some office buildings in Palo Alto or in Mountain View. Okay, it's now kind of morphed into a very what we call capital intensive business. It needs a lot of assets to kind of provide its services. Okay, so if we look on Google's balance sheet, we're going to see a lot of this of their data center assets. Okay, intangible assets. What are those? IP. What does that stand for? Intellectual property. So what are some examples of that? Art is tangible though. Art is a tangible asset. That's like something that exists in the real. It's like a physically real thing. Okay, I see where you're going with it. Coca-Cola Corporation. Okay, they have a huge intangible asset. What is it? Their what? Their logo. Yeah, their brand, right? And even their formula. Okay, how like whatever they're putting into their however they make their product, that's actually not an asset on their balance sheet. They've never transacted. Okay, there's never been someone that's like, let me buy the Coca-Cola brand. Okay, uh, so therefore, if you look at Coca-Cola's balance sheet, there's no representation of their brand value there. Okay, because there's never been a transaction that values it. If Pepsi was like, hey, I will buy the Coca-Cola brand for $50 billion, and they agreed to it, then you know how much it's worth, right? Uh, and that would be when Pepsi bought it, that would become an intangible asset. But it's only going to be valued when you kind of have a transaction. But there are many other, like think of a biotech company, right? They get FDA approval, they get a patent for a drug. That's an intangible. A patent is just a legal asset, right? It doesn't. It's a legal right. It's not actually something that physically exists, right? Copyrights, trademarks. Okay, these are all examples of intangible assets. And I'll go into the economic, like we'll talk about this in more detail. But when uh, Facebook at the time bought Instagram for $1 billion, it was like whatever 20 employees, and they were just sitting in an office space, and they didn't really own anything. So uh, what did Facebook pay for? Why did it spend $1 billion? Users, right? They had that network effect. They had the product already launched. They had momentum. That's an intangible asset that basically Facebook paid $1 billion for. And we'll later see how that would appear on their balance sheet, because at that time there was a transaction. That's the left side of the equation, assets. The right side of the equation is the financing side. How were those assets paid for? Okay, and there's two ways that happens. There's through borrowing. Okay, these are liabilities. That's financing through borrowing from others. Okay, so when we say assets equals liabilities on the on a company's kind of in that balance of their equation, The liability is going to be all their borrowings. It's not, we think about borrowing is like borrowing from a bank where you borrow money, right? But a company borrows in many, many different ways. Okay. When a worker works for 2 weeks, there are some jobs where I guess you get paid out daily, but what's like kind of the pay schedule for most workers? Biweekly, right? So for 2 weeks, the worker is actually, you're lending your employer your labor for 2 weeks. You're giving it for free, right? They're owing you those wages, and they're going to pay you after 2 weeks. But until that time, they're borrowing your labor. Okay, so that's the liability. We would call that salaries payable, right? Um, if a company's buying inventory, the vendor may send those goods ahead of time before the company's paid them. Okay, in that case, you're going to have a account payable. You're going to have a borrowing. Essentially, you're borrowing those inventory items from your vendor. Okay, so even borrowing from your customer. We talked about one business that borrows from their customer. What business was that? Does anyone remember? Where the customer is giving, they're going to give the company money, but they haven't yet received what they're paying for. What's an example? Yeah, airlines, right? So we talked about the airlines where the customer is paying cash to Southwest. Southwest has not delivered that flight yet. So essentially, they're going to use that cash to pay their employees, to pay for fuel for their current flights at that moment. But they're going to owe you a flight in the future. So they're borrowing from you, right? You're giving an interest-free loan to Southwest or whatever airlines whenever you buy a ticket. Okay, so uh, all these where the company owes either money or services or goods or something to a third party, that is a liability for the business. Okay, I think the tricky ones to remember are this idea of borrowing from your customer. We're going to call that unearned revenue. Okay, why is it unearned? It's kind of inherent in the name, but when you buy your ticket from Southwest, they're receiving payment, but they haven't earned it yet, right? We talked about that idea of revenue recognition when a company has to earn, they have to provide the good or service in order to recognize that they've kind of generated a revenue. Okay, even though they have the cash from you, they haven't yet fulfilled the second part of the transaction, which is giving the flight. So until that happens, you could always just get a refund for your flight. I mean, some flights are refundable, right? So if you paid Southwest, and you had a refundable ticket, they would actually have to pay you back if you never took the flight. Okay, so uh, that's maybe a tricky one. There's other situations like that when you hire an attorney. Has anyone ever hired an attorney or like know about how they accept payment? Will they just start working for you right away for free? What do they ask for? What is it? Retainer. Okay. A retainer is a prepayment. Okay. The attorney is like, well, I plan on doing $50,000 of work for you. Pay me 10,000 right now for the first 10,000. They haven't even started working, right? But as they work, they're going to earn that revenue. It's going to go from unearned revenue to after they've done work, they're going to actually recognize that revenue. Contractors, that's another one. In the construction trades, you got to pay your contractor up front, right, before they start working. So there's a lot of situations where this idea of your customer giving you money first before you've done anything, and that creating a liability, that happens. If your company also, you can receive services, right? If your toilets at your office building get clogged up, a plumber comes, fixes it, they're just going to give you an invoice. They did the work already, but now you have a payable, right? We're going to call that an account payable. That's a type of liability. So of course we have the bank loans too. That's also a liability. When you borrow cash from the bank, you're gonna have to pay them back. So all these are the different flavors of liabilities. Okay, so borrowing is one way of financing. The other way is the owners of the company are going to provide financing. Okay, and they do that in two distinct ways. One is called contributed capital. Okay, so right here, contributed capital. Okay, so what this means is exactly as how it sounds. It's the owners taking money from their bank account and moving it into the bank account of the business. Okay, so now the business has these funds available to spend on buying assets, paying the employees, paying the vendors. Um, in the vast majority of the cases, the way that owners contribute capital is through cash, right? You just write a check. Uh, it goes from your bank account, your personal bank account, to the business bank account, and the company then has cash available. There's other ways that owners contribute capital. I can think of one clear one in real estate partnerships. If there's someone that owns the land, right? They may, instead of contributing a dollar amount to the company, they will contribute the land. Okay, so they're transferring one asset, in the case of this real estate transaction, land, from their personal ownership to the company's ownership, and they're going to receive some stake in the company for that. Okay, now what is the problem with that? Why is that harder than, you know? Let's say you have 5 different partners and they're each contributing $100 of cash. What percentage ownership is kind of like the logical way they can split it up? If each is contributing $100 and there's 5 of them, and it's the same amount that they're contributing. 20%, right? It's quite easy because the dollar amounts are fixed. You know exactly the value of what each person is contributing. What's the problem with land? Well, do you know exactly how much the land is worth? Let's say I'm one partner in a real estate partnership and the other person has the land. I'm contributing $1 million and the other person's contributing the land. How should we split up the ownership? My $1 million of cash is clear, right? What about the value of the land? Is that clear? No, right? So that is, in that case, it's a negotiation, right? The owner of the land, are they going to say it's worth more or less? What's their opinion going to be? More, right? They're going to try to inflate it so that they can get a larger percentage of the partnership, right? While the other partners going to be like, no, the land is like not worth as much. So that's a negotiation that would happen when the company is formed. Okay. So oftentimes it's just easier to split up ownership when it's just cash involved. It's just it's a very easy mathematical just division. I guess one complication in that is if you have an owner, like when Mark Zuckerberg first started Facebook, he didn't contribute any money, right? He contributed the idea, his whatever. So how much of the company should he get for that, right? So that's going to also be a negotiation between those who are contributing kind of the operations and the other types of assets versus those who are contributing cash. Okay, so he would have had that negotiation with those venture capitalists who first invested with him. Okay, they would have had that negotiation. Okay, the other way that the owners will pay for things, it's through the profits of the business. Okay, so as the company generates profit, it has more assets and it's usually cash. Most businesses sell goods and services for cash. They're going to have that available to expand the business. Okay, and just like we saw with the house, when the house goes up in value, the bank is not going to get any more money, right? They lent a certain amount and that's what they're going to get. It's the owners who benefit from the profit of the business. Okay, so any earnings, any profit that the company keeps in the company and reuses to buy more assets to kind of expand the business, that's going to be the contribution of the owners, right? Because it's not required for the owners to reinvest their profit back into the business. They can take a payment from the company back to them. What is that called? What is the term for that? It starts with a D. Dividend, right? So a company, you could set up one little ice cream shop. It has a profit of $100,000 a year. And every year, that company will distribute to the owners that full 100,000, and it can continue operating like that. However, the owners can be like, no, we want to buy a second one, right? So with the profit, that 100,000, they roll that into buying a second location. right? So this idea of taking the profits from the business and reinvesting it, that's what this second part is. This is the retained earnings, okay? And there's two parts to it. Earnings implies the profit that the company makes. Retained means how much the company is kept inside and not paid out as a dividend. Okay, so both of those things, whatever that sum is, the profit minus how much they've paid out, and that is going to equal how much they've kept in the business, right? So, um, so again, the earnings is equal to the profit. This should be an arrow, not minus. Earnings and profit are interchangeable. Okay, they're synonymous terms. What is profit? Profit is revenues minus expenses. Okay, so we'll talk in the next slide about what exactly a revenue is and what an expense is. I think we all have an intuition of what these are, right? But you can think about it as, like what this company is operating to do something, to sell goods, to provide a service. So when it does this and someone pays them for that, that's going to be a revenue. Okay, and then retain, how we determine how much is retained is profit minus the dividend. Okay, so if you earned, in the case of the ice cream shop, if you had 100K in profit, but you paid 100K in dividends, that's going to have zero retained earnings. Okay, maybe you earn 100K in profit and you pay out 50K as dividends. So that means that you have 50K left over for the business to reinvest. Okay, so that 50K is going to be part of retained earnings. Okay, it's also possible, some companies do this, where they have either no profit or are at a loss, and yet they still pay a dividend. Okay, how do they do this? Well, they maybe have retained earnings from previous periods that they're able to kind of draw on. Some companies will borrow money to pay a dividend. Okay, that's dangerous. Is that sustainable? If your company is not profitable and you're paying a dividend, what's eventually going to happen? Yeah, bankruptcy. You'll just run out of assets and you're headed to bankruptcy if you're paying out a dividend that's larger than your profit. Okay, that's unsustainable.